Silver Dave here, and I'm gonna tell you how you're gonna be rich soon. Well, let's find out. So possibly you're not going to be rich, but I think there's going to be a at least gold, its monetary value, its price in terms of dollars is going to go up. And you're like, yeah, that'll make me rich. Well, not really. If it goes up and everything is, it's because the dollar's getting crushed. That's not really great, but you would have preserved your purchasing power and wealth. You will be like Zimbabwean rich, which is a special kind of rich, but it's, you could be a Zimbabwean billionaire. What's really going to happen, and I think we're on the cusp of this happening, and the stock markets are showing signs of it too, is we're on the verge of a double dip recession and a dollar crash. And the reason why I think we're going to be on a double dip recession is it's kind of normal. The economy is down the drain. Overall, a lot of people are out of jobs. Jobless claims have been up. They've been going up. And the dollar has continuous weakness. Dollar weakness is typically a sign that, foreign investors don't want to buy dollars because they see, American assets as a giant risk. And it is a huge risk because there's the risk that, the economy isn't there to support the dollar. There's a risk that there's quantitative easing that could come and stimulus, which will further devalue the dollars. And if you hold your assets in a different currency, whether it's gold, whether it's Bitcoin, or whether it's the Swiss franc, it's the Japanese yen, the euro, the Chinese yuan, or even Zimbabwean dollars. And today you're thinking, okay, if I put it in actually maybe not Zimbabwean dollars, but if you hold it in any other stable currency, you're very unlikely to say, oh, tomorrow I want to buy dollars and it's going to go down. You don't want to buy dollars at that point. Also, another key point is that, right now with all the restrictions and the uncertainty, people aren't traveling. And you have to factor in that when people travel, one of the most common currencies they carry along with the currency for their target destination is they bring dollars. You're like, wait, why do they bring dollars? Because imagine this, if you are coming out of, India, what is the first currency? Even if you're just going to Europe, what is the first currency you would buy? You'll buy some euros, but you will also buy some dollars because you know that yes, the rupee, it might not be accepted everywhere, but the dollar is accepted everywhere because it's a world reserve currency. There will be exchange rate with the local currency, and it is the only currency that has an exchange rate with every single local currency around the world. That's the power of the dollar. That's not the case for the euro. That's not the case for the yuan. So, typically from people from those countries, they always have to go through the dollar. And right now, with less travel restrictions, with more travel restrictions, people aren't buying the dollar. And this is kind of bad. It's not great. It leads to a lot of dollar weakness. And, I've been saying, you should be watching out when the dollar's weakness slows down in this period. And one of the reasons for that is, if the stock market and the US stock market also weakens, one of the first things you see is that the stock market, the money in the stock market, leaves the stock market and they go into dollars. It's a short-term trade, right? They go into dollars for the short term because there's a fear of stock market crashing or stock market volatility, according to the more Wall Street types who want to stay correct. But essentially, it's a giant shitstorm. If they expect a shitstorm to hit the fan, then the first thing you see is the dollar jumps a little bit upwards relative to safe haven I would say long-term safe haven currencies such as the Swiss franc or gold. You see some strength in it. And then later on, you see further dollar weakness. And what do I see today? Well, in terms of dollars, yesterday we saw a sort of a small strengthening of the dollar, like a tiny, tiny little dip there. We saw some strengthening of the dollar. We saw weakness in the stock market. And then today we see more long-term strength for a safe haven currency, such as the Swiss franc. So, for me, this is a sign that the stock market is right now at a pivot, like a turning point, a potential turning point. I don't have a future, like a crystal ball that tells me what's going to happen tomorrow or next week, but it's not a good position. It's not like you don't want to buy a lot of stocks at this moment. You want to be very, very careful because you could be buying into an all-time high that you can never reach again. This is a very, very dangerous situation if you are in the stock market. It's a opportunity. So you can see today the stock market is pretty much down. Yesterday it was at a high, down. It went down quite a lot. Then this is the S&P 500. And then pretty much we are on a, here there's some recovery, but it's grinding sideways. And potentially we could see further lows before year's end. And that could be a possibility. If you look at the RSI of the stock market, it's there's weakness. It was quite overbought. I mean, it was overbought for a long time. Possibly there's some overselling. People believe that it's being oversold. If the dollar weakens further, there will be some investors for whom, even if there is some defense on the stock market, like I would say at the 3,600 level for the S&P 500, it doesn't make sense because the dollar is just weakening all the time. And this is what I call like the domino effect. If the dollar is weakening and the stock market's not growing and people are leaving the stock market because it doesn't make sense for them to hold American assets because of the weaker dollar, and they're losing money in their own currency terms, they're bailing out. And then you have more people, I would say domestic investors, investing into the stock market to defend a specific point. And then at the same time, the people who just bought the dollars, who got a little bit stronger, they start selling off dollars and they're strengthening other currencies. The dollar drops further, there will be another wave of a sell-off. And then it just continues until a certain point where people panic. People panic and they start massively selling off. And the people who enter the bear markets, who entered this selling point, and you break the stop loss point of people entering that point, the computers will start selling off. And then that's when we hit like stuff like circuit breakers and all this other type of automated stop gaps. But I think we're potentially at the cusp of seeing another a pretty big correction. I don't know how big. Honestly, like I got in an argument recently, and some people are saying, yeah, we'll never see like recessions like the 1929 recession, the Great Depression. It won't happen. Governments will step in. Look, I don't know. All I know is right now, if you look at the stock market in terms of the long-term stock market, it's overvalued. You look at the earnings of the companies that make up the S&P 500, and it's really not that healthy. And then you look at how much the stock market is valued relative to the GDP. You're like, yeah, it's like K-shaped, and that's like not a good sign. Usually there's a convergence to the mean, and they will converge. But usually, like if the usually it converges towards the economy I would say in the long term. And right now, there's a lot of strength pushing to the stock market down. Now you can say like, okay, but why was gold flat? Well, you have to remember gold is a currency, right? It depends on how is the dollar valued and also how the overall market is and everything. I think right now there's some people that think that this is a buying opportunity and they're like dumping their gold investments to short positions and buy some more positions. And then at the same time, there's dollar weakness. This is bad for a market. When you have the market going downwards and gold is somewhat flat and slightly downwards, and then you've got strengthening of foreign currencies, it's like a perfect storm. It's something that it's like, if you're in this position, I would just like sit on the sidelines for a little bit, because it could be quite a risky position. You know, it's not great. One of the things that worries me the most is ETFs, and the fact that there's so much money like rolling around in ETFs, and so much money in sort of these passive funds that, you know, maybe like when they first started, a lot of the companies in these funds right after 2008, they were like, after 2008 there was sort of a culling, and only the fittest companies survived. And over the course of 8 years, of course, if you put it into passive funds, you profited quite well, and there were pretty decent returns. But at this moment, not every single company is healthy in the fund. Now, what could happen is, if we do get stimulus pretty quickly, you know, they could be propped up, and you essentially have a bunch of zombie companies in the funds, and as an underlying asset, you know, stocks of zombie companies, and that's not good either. The Eurozone is doing this. The Eurozone is propping up their economy. You know, it went dipped, it went back up. There was news that the ECB was going to unleash stimulus, 600 billion. This could shore up the economy in, I would say, the mid-term to the short term. I don't know what will be the long-term effects of this. I think one of the long-term effects is that, you know, the European debt will be pretty big, and we're going to see oligarchic growth in the EU zone. We'll see massive asset inflation in the EU zone. Like, we'll see relatively those who have assets will become much more wealthy in the EU zone, and those who don't have assets in the EU zone will have less. Essentially, it's going to widen the wealth gap. Not necessarily the income gap. The income gap might stay relatively flat, but the wealth gap, definitely, it will widen after this. What do I think? You know, the U.S. is in a similar, investors are in a similar boat. You know, they're looking at stimulus. I think, you know, there is a scenario. Now, I have to consider all scenarios. There is a scenario. Like right now, there's no stimulus. There's talks about stimulus. In my mind, there is one scenario that tells me that potentially we're not going to see stimulus in the United States. And the reasoning for that scenario is a theory. It's not fact. This is a theory. My theory is the current politicians in the United States, on both sides, both the Republicans and the Democrats, they want to see what happens in Georgia in the elections. They also, neither of the mainstream politicians want to give credit to Trump, right, for an economic recovery, because Trump has tied a lot of his sort of economic success and his sort of his score sheet to performance of the stock market. Potentially, both sides of the bench at this moment, you know, I'm just looking at what it is. I don't know if it's true or not, but I do get the feeling that mainstream Republicans, you know, they're using Trump to gain popular support, but they really don't care about him. I mean, they would throw him under a bus if they could. As long as they get the votes and they get their seats, and they win their like local elections, they will use him. And if he's no longer a useful tool, well, you know, bye-bye. Hey, you know, he's written off. And this isn't, you could be on either side of, you know, you could be a Republican supporting Trump, but I'm not like against you. I'm saying that this is what I see these people in Senate and Congress doing. This is what I'm seeing, that like, if I look at what they're doing and not listening to what they say or what's, you know, what their positions are or their ideologies, I'm looking at what they're doing is they're literally just using him to get, you know, to get their seats. That's what they're doing. And I think that right now, once they're done with that, they don't feel like they need to give him credit for anything. They're going to make it crash, make him look bad, so that he never influences their political power again. And then afterwards, they're going to say, "Oh, we worked together, and then we saw how bad it was for everybody, so we decided finally to provide stimulus for the people." And this is like, this is politicians from both sides of the aisle. Not just like, I'm saying that this is as much Democrats' fault as Republicans. I think in that scenario, they're both on the same interest. I'm not saying that they're on the same political side, but enough politicians have that interest of crashing the market and then propping up afterwards to give themselves credit to do it. And and of course, at this moment, they're making stimulus talks and saying that they're being productive and all sorts of stuff. That it's just talk. It's like marketing and hedging their bets. Their bet is that they can do it, and if they do enough like before, people won't be angry enough to riot and take you out on the street to appease the masses. It's such a, I don't know, it's just like such a political move, it's a ruthless political move. That's why, when I look at what politicians do, I never listen to what they say. I look at what they actually do. You can't listen to what they say, because if you listen to what they say, it's never true. You have to look at what they do to get an underlying sense of what's going to happen. And what they've done is, they could have passed different types of stimulus, but I think there's no will on either side to pass anything before, because there's no interest for either, for either side to pass anything until the market crashes. So then afterwards, they can come and swoop in and prop it up with stimulus. Now, there are certain things that they cannot control, right? When they prop it up with stimulus, they can affect the stock market, they can affect the bond market. But what they can't do, and then what they really don't care about doing, is controlling the price of gold. That's how I'm saying you might become Zimbabwean rich. Because really, the price of gold depends on the value of fiat currencies. It's compared against fiat currencies. I always tell people, gold, it's more of a currency risk protector than anything else. So in terms of fiat currencies, the numerical value you will see for gold is going to go up. Asset prices, most likely, if there is stimulus, any type of sort of asset is going to go up, especially core assets like land. If you, like right now, if you had a lot of money, I would say you buy up natural resources. Like, that's the best thing you can buy at this moment. You go and especially if you have access to loans, to zero interest rate loans from European banks, just borrow zero interest loans and just buy up tracts of land that that can be farmed, that can be built upon. Just buy strategic land, and you will make a killing. Especially going forwards, into 2021 and into the future, especially since a lot of retailers are going bust. E-commerce is going to take over for a lot of them, and they need depots, cheap land to build depots on, and then they need delivery centers, and that's where the next growth will happen. And if you have enough money to buy up enough strategic land and strategic core resources, it's going to increase. Will gold jump up? I think, like when I look at what's happening to gold over the past few days, I do have a feeling that we are in we're going to see something soon that we have not seen for quite a while. And it's not necessarily the rise of the price of gold. Like I said, if there is a crash, what you might see is gold correct downwards. Not a full crash, not at the same pace as the stock market, but that gold will correct downwards in the short term, along with the stock market, but it will recover faster because the dollar will be crushed. And yeah, especially if the economy is really in a double dip recession and the stock market crashes because no company, very few companies will be profitable. Foreign capital will move out because they will want to protect their assets too, their value. And they'll move out to the dollar, and they see the dollar's getting crushed, they'll escape the dollar. That's going to drive a knock-on, sort of like a self-feeding loop. You know, you can imagine if the stock market is going down, right, and the dollar's going down at the same time. That's for any type of foreign current like investor. That's a huge like drop. So they're going to sell their American assets. It's going to drive the assets lower. They're going to have a bit of dollars. It's going to go up a little bit. Then they're going to sell their dollars. It's going to go down. Other investors look, oh my God, it's dropping. Instead of like just a stock market dropping 20%, they're having even more drops, and they're going to sell. It's going to lead to like a downward selling cycle, especially for foreign capital. You're like, yeah, but most investors are U.S. capitals. Yes and no. A lot of, you have to understand, a lot of world's like global pension funds, they are invested into the U.S. markets, right? Either they're not always directly invested in. They buy products, underlying products that is sold like by a local branch of JP Morgan or something. And then underneath those products, there's like ETFs, and there's all sorts of layers of products tied to the overall broader market. And if those things start collapsing, there's going to be money moving out. It's going to be sort of a pretty horrible implosion. I did make some people stressed today when I was talking this to out of context, not with people online. I was talking to people offline, and people hate it when you're the bearer of bad news because it makes them stressed. You tell them like, this is a potential scenario. It could be pretty terrible. And they worry, and because like I'm saying this sort of like as a as a mental exercise, and then I go and buy some gold, to protect myself, and I buy like some stuff to try and counteract what I see as a potential effect. But not everybody's in a position to do that, because especially if, for example, if you're near retirement and you're expecting your pension like soon, you have a pension fund and you gave them all your money, and you're soon near retirement, you're like, oh shit, if they implode, my retirement's gone. That's the reality. It's not the reality. Hopefully it won't. I think in the short term it won't affect most people who might go into retirement soon. But as for people who are expecting to go into retirement maybe in 15 years, there could be a lot of pain in the works, and they should be more aware of what they're putting their money into. I've had the case where recently I was approached by some financial advisors. I do have some financial advisors that I don't buy a lot of stuff from them, but actually I haven't bought anything from them. But they're there to show me like the different products that's available, and they've been pushing really hard for me to invest into rental real estate backed securities. And I was like, yeah, well, who's gonna pay their rent in the current situation? They're like, yeah, it's pretty safe, and also we've got this commercial real estate backed security. And I just sat down and I was like, okay. I had to go through a lot of research to find out the ISIN numbers for those securities. And because if they're selling you a security, by law, it has like an ISIN number, and it is you can track it and you can look at its performance. And when I looked at the brochure, they essentially showed in their brochure sort of the average gain year on year till date. What I looked at was actually, during the recent periods, why was it like an average? I think it was an average of 4% per year. Well, what I found was initially, when the fund was initially started, people who had the inside, the first people who were the insiders, they could buy the fund at like I think $104 for one unit, and then pretty much afterwards, like I think in 2018, they opened the fund and it jumped to $120, and then it's been on sort of a downward trajectory, and right now it was super low, especially since March. It hit from 120 down to 115, and it's like on a further downward trend. And I look at it and I'm thinking, fuck yeah, of course it's like 4% every single year if you like average it out. But honestly, like from this point onwards till the future, will it still be 4% year on year? I doubt it, because like looking at, and then I went into the balance sheet of the underlying assets. I'm a little bit obsessive, and I tend to try and look at everything. And I went in to look at the underlying assets like line by line and see how they were evolving, essentially to add more assets into the rent-backed fund. So if you ever propose a rent-backed fund, you should look at if you have access, you should try and look at what's the underlying like buildings, like which buildings are there, what's the the eviction rate, and what's the vacancy rate. And what I saw was initially in the first building was the fund was like $104. Most of the buildings were they were relatively central residential areas near major hubs of commerce and business, and the eviction rate was around 1%. Then as the fund grew, in order to expand the fund, they started adding more residential areas. Of course, the average rating of the fund was still good, because the volatility, the risk level, it was still overall it was still good, but there was more trash being added to it. I saw some places where the eviction rate was around 46%, and I was like, oh wow, this is like one of the more recent ads. This other place, like last year the eviction rate was like 20%. Oh, here it was like the vacancy rate is 7%. And where did they buy this building? Oh, it's in the middle of the mountains somewhere. Here it's in the ex-industrial zone that is a little bit defunct. People don't live on this area anymore, or this area is relatively isolated. Of course, there's a new building there, and they added the value of the building into the fund so they could, say we have more potential renters, and they could expand the fund. But there was no way for them to expand the fund unless they bought buildings, and there's not so many buildings that they can buy with great renters and great locations. So you really have to be careful when you're buying any type of like bundled assets. What are ETFs? Bundled assets. In an ETF, there's like different weights for different assets. And during the sell-off, they have to rebalance. It's a complicated mechanism. And if in the rebalancing, they've only got like terrible assets, most of the terrible assets just tumbling down to zero. And even if the higher weighted assets, what I think could be happening right now is there's some assets that are weighed more right now and they're performing well. But if those assets turn negative too, then you're going to see the funds move down so fast. It would be really bad. Hopefully we don't see that. I don't really want to see that. I've been through the last recession in 2008, and I'm okay. But I've seen how it affected. If you haven't guessed, I'm not that old. I'm a millennial, but at the same time, I know that like around 40% of my friends who graduate university at the same time as I did don't have jobs today. It's not that like they're not looking for jobs; they're applying to jobs, but a lot of them are just out of the workforce. They're not doing. I would say they're not doing the full like capacity of their skill sets. Either some of them have gig jobs or some of them just don't have jobs. And and I would say only a small percentage are doing well. There's only very few people who are earning more than what their parents were earning at the same age. And that's something. And I can tell you that amongst people who are younger, I have siblings, and I have a younger, in my younger siblings group, they're like Gen Z. I know that, how many? I know 10 of them. And I would say one person has a gig job, and another person has sort of this thing. He tried working a little bit. He has some internships, but he couldn't get hired. Like, companies are not hiring because they are hiring, but they have very few positions open, and the competition is so fierce that there's no entry-level positions are being taken up by people with better qualifications because people want to enter some. Because if you have the right qualifications, it is easier to find a job, but it was very hard, for you to predict what will be the next needed qualification. I mean, could you predict that now everybody will be working on computers like 30 years ago, or 20 years ago, or 10 years ago, that everything will be automated, and maybe like if we studied machine learning and data science, it would be better? No, nobody could have predicted that. Like, people, it may be like, nobody would have been able to predict that. If you thought that you would become a pilot, that could be a good job. Yeah, back then, maybe like, I don't know, 2 years ago, being a pilot, there's a shortage of pilots. Being a pilot pays quite well. Right now, there's a pandemic and nothing's really flying unless you're a cargo pilot. Passenger pilots aren't doing so well. It's quite a special situation. And anyways, to conclude, we are going to see most likely, I'm not sure, it's never 100%, but I think we're going to see more downward momentum for the markets. We could see a self-feeding loop of sell-offs due to foreign currency flight and dollar weakness, and just people exiting the market. And if the ETFs are overweight with a lot of crappy assets in them and the whole market's tumbling, we're going to see very, very, very quick sell-offs. People forget that ETFs have to buy stocks, but ETFs also have to sell stocks when the market tumbles, and that could feed into the selling frenzy. Also, from what I see, not from what politicians are saying, I don't think there's an incentive for them to pass anything before the market actually crashes. Because if you think about it, if the markets actually crash and they come in and save it, they look good. If the market doesn't crash and they save it and it just like is anemic for like 5 years, it doesn't make them look good. It makes them look like they wasted money. So yeah, I think the markets will have to crash before they pass anything, and then there's just going to be so much pain before recovery. And I feel like, not that I feel, but I have good reason to believe that the dollar, most likely could get crushed. I've been looking at Luckin Coffee. It's one of the crazy things that entered the market earlier this year. You can still buy Luckin Coffee over OTC. I don't recommend people buy Luckin Coffee at this moment. Actually, I don't know. Do whatever you want with your money. But I do think that a double dip recession is in the books at this moment. I do think that the dollar weakness is going to continue. There's no reason why it should not continue. And I think that the price of gold has a lot of upward pressure in the midterm to long term. But in the short term, you could have some buying opportunities show up. And you shouldn't be too worried about gold moving downwards, because it is one currency that you cannot quantitative ease very easily. And the dollar, they will do the easing, they will do the stimulus once the market's like correct. And that's the point where they'll have an incentive. Then they can tell the general population, look, we saved everybody by giving out stimulus, and they'll hope that you forgot that they put off giving stimulus for such a long time, for almost like 6 months. And then they're like, we saved everybody. And then they'll get reelected again next year. It's all a game. It's just all a game for some people. And as long as people are willing to play the game, it will continue. And yeah, if you ask me, people will stop playing the game. No, nobody. At this moment, I don't see a world where people are willing to stop playing the game and do the necessary things to stop the game. Because to stop the game, this has been done in the past. It's just that there's no, it's just impossible to stop the game right now. there's the people who are playing the game have so much power, just way more power than anybody in the past has ever had, and way more control. And you just have to like just realize that what they're doing, and keep your eyes open. Yeah. Well, I hope you've been stacking, because potentially if you're stacking, you're going to see some upsides. And I hope you keep stacking. I hope everybody. I'm stacking. I'm going to add some more stuff to my stack, and I'll do a video of an update of the stack of what it looks like, probably this weekend when I have more time. So keep stacking, stack in good health, and click the like button, click the subscribe button, helps out the channel. And thank you very much for watching. Stay in good health. Dave out.